That Stevie Wonder song, very superstitious, because I don't know if you've checked the calendar yet today, but it is Friday the 13th, and so if you are superstitious, today may not be your day. And to top it off, we're also going to experience a full moon tonight, so you got a double whammy. So if you are superstitious, lock the doors, hide the kids. Today may not be your day. Stay inside because you got a double whammy coming. Well, I'm just getting with you here to let you know what happened with interest rates. And rates finished the week a little bit worse than where they were last week, continuing kind of the trend. But it was not due to superstition. It was more due to technical factors, as well as equities, stocks, actually posting record gains actually earlier in the week, multiple record gains. Both the Dow Jones Industrial Average and the S&P 500 posted records a couple of times this week, earlier in the week. And in fact, the S&P 500 actually is up about 190% compared to the 666 low that it experienced on March 9th of 2009 during the low point of the recession. So quite a rebound in stocks over the last few years, and that put a little bit of pressure in interest rates. In terms of economic data, pretty light week. We really didn't see a whole lot of stuff going on. There are some geopolitical concerns right now this Friday going on with what's happening in Iraq. There's some concerns over there, but it's not a major concern. But we did see some economic data that was released. We saw the retail sales come in, and that showed a actual increase of 0.3%, which was a little bit worse than what the market expected. Market was expecting 0.5%. We also saw the producer price index come in, which showed actual decline of 0.2%, with the core rate showing only a decline of 0.1%. But that was off the expectations, and it's actually kind of important because we've seen retail sales, producer price index and the consumer price index showing some positive numbers over the past few months, which could be inflationary. Inflation's typically bad for interest rates. So to have this number come in weaker than expected is actually probably a pretty good thing for interest rates. Maybe not great for the overall economy, but a pretty good thing for the longer term in terms of interest rates. We also did see consumer sentiment come in a little bit weaker than expected, and Fannie Mae released their 2014 May housing survey, and they said that 2014 will probably experience a slowdown in the housing sector compared to what we saw in 2013. Still a good year for 2014, showing some appreciation, but definitely off its peak from 2013, and that's due to tepid growth in income figures, that the consumer is just not making as much money, as well as 60% of all the respondents did say that they believe that the economy is moving in the wrong direction. So if the consumer's not feeling great, they're not going to be buying as many houses, and so that's why Fannie Mae said that there could be a bit of a slowdown this year compared to last year. Next week, we're going to see some numbers on housing come out. We're going to see housing starts, building permits come in, and also the builder survey. We'll also see the consumer price index, so we'll see if there's inflation happening in the consumer level. And we'll see if the concerns over Iraq are going to continue. Generally speaking, I think the overall trend for lower interest rates later on this year probably is in place. We may not see that happen. We might see a bit of a rally come July and August in terms of forcing the price of mortgage-backed securities to go up, driving the yields down, driving interest rates down. I think that probably might materialize here within the next month or two, but we'll keep you informed. Hope you guys have a wonderful week. If you are superstitious, have a very safe week. If you have any questions, always give us a call. We'll talk to you later, and thanks for joining me with Job with Jared. Bye-bye.